Hi, everyone. Thanks for joining us today. I'm Melanie Marie Boyer, the Executive Director of the Pittsburgh Metropolitan Area Hispanic Chamber of Commerce, and this is our Latino Pittsburgh Speaker Series. Today we have a special guest speaker, Adan. He's with Lionfield Capital, and he's going to be talking to us about mergers and acquisitions. So, when you're watching the news, you might hear about one large company acquiring another, or even a large company acquiring a small family-owned business. And we have a lot of businesses, even in our chamber and in the region, who may look to go down this road one day, or maybe you're just curious about what happens behind the scenes. That's what we're here to talk about today. So I want to welcome him. Hello, how are you?
Hey, Melanie, how you doing?
I'm doing wonderful. Thank you so much for joining us. We're really happy to have you. This is a topic that we don't often get the chance to really learn about. We see these announcements on TV and we kind of pass them by. And I'm just excited to take a deeper dive and learn a little bit more. So do you just want to jump right in?
Sure. I mean, I think we can sort of start in an instructor way. And I guess hi everyone to everyone that joined. Lionfield is sort of the first fund of this kind that has been raised and launched by Hispanic Americans or immigrant Americans. We're super proud of that, and we're starting the journey of this fund, and partnering with the Hispanic American population, right? And I approached Melanie. I loved what you guys were doing in your Chamber of Commerce and thought it would be a great way to connect. And Melanie said, great, why don't you give a little talk on your field? So this is sort of a first for me. I hope I do it well. Just please, give us questions, keep this entertaining. I'm by no means an engaging presenter, so we'll do our best, and we'll take it from there.
Well, thank you so much. We're really happy to have you. And it's really amazing to see what Latinos are doing out in the community. So for everyone watching now and in the future, we're very happy to have you join us as well. I'm going to pull up the presentation.
Thank you. There you go. Cool. So guys, just for background, my understanding is that the audience right now is a mix of students, business owners, young professionals looking to pivot. Perhaps you guys have some interest in finance or mergers and acquisitions. This little deck has a little bit of everything. So again, just drop your comments, questions, or Melanie can voice them, and we'll give it a shot. As I was talking about, I work for Lionfield. I'm the managing partner and co-founder of a private investment firm out of South Florida, and I'll give you the whole story shortly. Also, this is sort of what we have for you guys today, right? I mean, I'll give a quick intro to some of my background, personal and professional. I'll share a little bit about what exactly we're doing at Lionfield, and we'll get a little technical and talk about M&A, right? Which is where I spent the past decade or 12 years specifically, just doing mergers and acquisitions for a variety of companies in the U.S. and all around the world, really. We'll talk a little bit about the psychology or the thought process behind doing a transaction, whether it's an acquisition or a divestiture, and obviously have some time for Q&A. Look, on the personal side, I'm just gonna go super brief because I think this is literally the most boring part. I was born and raised near the Arizona border, medium-sized town called Hermosillo, so on the other side, and I grew up kind of on both places, right? I have family on both sides of the border. More on the personal side, later in life, I spent a year as a missionary and then half a year living in an orphanage before I kind of married to the devil and did mergers and acquisitions. But that's a beautiful part of my life that I did that, and I guess I loved that time in my life, and it really framed how I conduct myself or how I think about business and people in general. I studied a little bit in Canada where I had a phenomenal teacher that gave an incredible lecture on mergers and acquisitions. So I was infatuated with the topic. And I returned to Mexico at some point and tried to get a job in M&A. Actually, I was a huge nerd. I wanted to be an academic, so I was hoping to do some research on mergers and acquisitions, and how this affected countries and the economic cycle. So I actually, back then, I called literally the governor of the central bank and say, hey, I'm Adan Sierra. I love to do this type of research. And they said, hey, kid, you're super cute. Good luck. This doesn't exist in developing countries. So go back to where you came from. And anyway, I ended up working at PwC for a bit, begged them to do mergers and acquisitions, and ultimately ended up pivoting, right? I badly wanted to do this. I ended up working for a firm that was doing a ton of M&A, that had a Latin American component. So a lot of US companies, acquiring or divesting, within the US and elsewhere, and particularly many consumer products looking to grow within the Hispanic market. And so that kind of led me working in banking, right? I mean, I spent, as I mentioned, a little bit over a decade working in investment banking, focused on M&A, working for these big companies and a lot of, fancy families, third or fourth generation. And it was super fun, very academically engaging. You meet all these fancy executives, but I always wanted to be the decision maker, right? I mean, I wrote here. I mean, I wanted to be in the movie, not just watch the movie, and it was driving me nuts. Monetizing these assets and doing these transactions and just kind of seeing it from the sidelines. So, long story short. Went back to school, went to Northwestern, Kellogg, got an MBA, and said, hey, I want to be an entrepreneur, and kind of, I've obviously wanted to capitalize on what I was doing. So I raised capital, family offices, investors, and other institutions, and raised this fund with a friend, and started Lionfield Capital. And we'll talk a little bit about it. Melanie, so far so good, or?
I do have one question. I would love for you to just touch briefly on your Hispanic background and if you feel like that affected you in your education and your professional endeavors.
Yeah, for sure. I mean, Hispanic background, I guess, grew up in Hermosillo, right, which is a medium, small town, really. I grew up in a very close held family, had a beautiful childhood, I guess, and always had this concept of family just very close to my heart, and that shows, right, how I talk with people, the things that matter to me, and even now as I analyze investment opportunities and I see the founders and the owners, that matters a lot, and honestly, you see businesses that are able to create more value to their shareholders, to their employees, to the community, just because they have those components. So family and the way Hispanic families kind of construct their life has been incredibly important. Certainly shaped me, and my favorite wish right now is that I can instill the same sort of principles in my own family, right? And I'm the one that immigrated, right? And I'm kind of creating my own family apart, or I guess different as how I grew up, just because I was close to my grandparents, all my cousins, all my, everyone. And here I ended up marrying this American that I brought to Mexico, and she said, "You're nuts if you ever think we're gonna go there." So I'm kind of stuck in Florida for now. So I'm doing my best to instill that, I guess.
Well, we're definitely happy to have you.
I hope my wife didn't join, but we'll move on from that.
Yeah, tell us a little bit about the journey professionally, what you've been through.
Yeah, I mean, as I mentioned, right? I mean, last year, I guess I'm the managing partner of this private investment firm. The purpose of the fund is to look for companies, that are facing succession issues, or companies that need management. We're looking as big as $50 million. And I think what's unique about it is that, unlike a typical private equity that's looking to build a portfolio, we're really looking to help that owner that is really looking to retire, that the second generation has no intentions whatsoever working in the business. They're painters, they're musicians, they're poets. They got a lot of money. They have no needs to kind of go through blood, sweat, and tears of what it takes to build a business. And we're looking to do a control type of acquisition, acquire the majority, so that the owner can retire, chill, enjoy their golden years, and that they can leave the companies in good managers that are backed by deep-pocketed, more experienced type of people as well. And that's sort of the purpose of the fund. We spent the better part of last year fundraising. That's a whole nother talk. It's super fun and it's very, very challenging for a lot of reasons. But we spent many months fundraising, and then we're officially launched, I guess in February or March 1, I'd say, and started looking at a variety of businesses. We're looking, we issued an offer for licensing and compliance business for the insurance sector. Another one for a helicopters business, and we're looking at another one in the point of sale solutions industry. So, we're fairly industry agnostic. We're mostly just looking for that type of situations where we can add more value. So as I mentioned,
I would say, so what we're looking at here is we're looking at either a person or generations even of a family who have built up this business over time. They've put so much into it. And now they're at the point where they're looking at the future of the business and they don't know what capable hands to put it in, but they want to enjoy retirement. They want to enjoy their lives. So by selling essentially to you, it is guaranteed to be in capable hands and keep moving forward and, leave the legacy intact. Am I right?
Well, look, Melanie, I would be far more humble than that. Like, I'm by no means, perfect, but I think what's different is, I got solid attributes and I'm a fine worker, but I think what's different is that, the type of partnership we have. My partner comes from a phenomenal operational background. I've been a banker for most of my life. I'm not saying that I will be a phenomenal executive, but our investors are just world-class type of executives that have been incredibly successful, and they're betting on our future, and they also would like to be involved. We have one of the guys that he grew a pizzeria chain and all the way to $500 million type of business now. One of the guys that built an incredible communications business. He's now part of the owner group of the Celtics. Anyway, he's just a phenomenal group of individuals that are backing and betting on us as principals to take over this type of businesses and grow it. Obviously, I think for owners, you're looking at a fund that wouldn't be especially focused on just stripping the company away and looking to reduce costs and fire everyone. But in our case, we tend to just capitalize on what has been built, including the legacy and the name of the one owner, and grow it. That's the only thing we care for, just growth. And you don't see this with typical competitor or strategic buyer, right? I mean, if you own a restaurant and you buy a restaurant, you'll typically like to rebrand the restaurant. It's a bad example, but we wouldn't rebrand anything. We would capitalize on the legacy that an owner has created for decades, essentially.
I love that. Thank you.
I gave you a very long answer, and I should have just said yes.
I love
it. But look, anyway, kind of getting back to this. Prior to Lionfield, I was working for a middle market boutique investment bank at a DC, and as I mentioned, right, we're doing a ton of typical M&A work for many multinationals and obviously some families. Some of the big ones, we did an acquisition for Hertz. That was a $1 billion deal when they acquired Dunlin, and then merged a couple of Coca-Cola bottlers. In particular, one that was sort of they were the first Coca-Cola bottler in Mexico. It's called Grupo Tampico, and they ended up merging with another very large Coca-Cola bottler. That was a 100-year-old type of business. Did a lot of work for General Electric, Tyco, now Johnson Controls, and many Latin American conglomerates as well. In parallel, I tried a different type of entrepreneurship. At some point in my life, another very long story, maybe with drinks, Melanie, but I launched a yoga line. We were selling tank tops, sport bras, and yoga pants with my brother and my wife back in our house in DC, and then worked for PricewaterhouseCoopers for a little bit. I mentioned went to Kellogg, and before that went to Monterey Tech and studied finance as well. I'm gonna pause there. Any questions up until now, or anything that I should focus on?
I love the progression and the constant, always coming back to entrepreneurship. I love that drive in you, and I think so many people, who are part of the chamber, and especially over, COVID, so many people realize that they're not quite happy in that 9 to 5. So it's just great to hear the entrepreneurial spirit, especially starting so early. So I can't wait to hear the rest.
Well, the rest is sort of more technical, but I just touching on that, right? It's certainly part of the whole, immigrant journey, right? I mean, I always had that drive. I don't come from money, and I kind of ended up in this beautiful country and trying to kind of carve a path on my own. Sorry for the thick accent, guys. But moving on. Anyway. So look, on M&A specifically, which is my expertise, if you will, why, I call this section why it matters, right? And this is sort of a quick map of the scope of work. The way you categorize or conceptualize this, companies often or frequently are asking themselves, hey, what can I do with my business? Should I grow it? Should I sell it? Should I just maintain it? And obviously, depending on the decision, you start having a lot of sub decisions, right? If you say, I love to grow this business, you say, great, I need to invest. And is that investment, should I just, purchase a new machine, open a new location? Should I just go buy out my competition? Those are growth decisions. And I was obviously focused on this part of the chart. I don't know if people can see it. It's the green bucket top left. I was focused on what we call inorganic growth. Organic growth is just opening new locations type of thing. The other area that I was heavily focused on, it was on sell decisions, right? I mean, people just families, for example, will say, hey, my great grandparent started this Coca-Cola bottler. We're one of these rich heritage type of families, and it's time for us to kind of merge with someone bigger that can have a better cost profile, and obviously we'll love to monetize this big business, right? I mean, that and those are typical decisions that all these families go through. And for multinationals like Johnson Controls, they'll say, hey, we have this, we're electronic components type of business, and we happen to have, for random reasons, a security division in Canada, which is not the core of what we do. Let's sell it, right? Or I'm a oil tycoon. Why do I have a newspaper, right? And people, owners will just often say, hey, it's time to rationalize and divest that portion that doesn't really aggregate a lot of value. So I'm going to talk a little bit about the green bucket and the red bucket, and like I mentioned, right? I mean, we're going to talk a little bit more about what goes in these of things. So this slide I love, right? I was talking with Melanie that companies, or a lot of people just see the headline and say, hey, I saw that Google bought YouTube, or that Fiat acquired Chrysler, or whatever. You see many headlines of companies buying other companies, and it's it's fancy, it's sexy. You usually have a big headline number, but it happened. There's a lot of work that happens in the back end. Sometimes it's months or years of work, and there's all these academic reasons of why companies engage in acquisitions, right? And the typicals you will see are, hey, we want to gain market share, right? Or we want to increase our manufacturing capacity. And I provide this examples. We want to expand in another location. We want to increase our product or service offering, right? I mean, we're a security company. We have guards, man guards. We love to do monitoring or video monitoring type of thing. Or we would like to acquire research talent, for example, like Cisco did, and at some point in life. And those are, great. They make a lot of sense in paper. The what I really love is, what happens in real life, because you don't see it, but there's just a lot of psychology that plays into it. There's a lot of FOMO, for example, and this is what I love. You see the big headline, but the reality is, one time a CEO just saw that his competitor bought the third largest competitor, and they're crushing it, and they're gonna smoke the second competitor. So the CEO of the second competitor would just say, well, shoot, now I got to go buy someone else. And boom, that's it. That's the decision, right? And then, a lot of it also comes with this signaling. Like, hey, it sounds sexy to say, hey, I bought something, as opposed to, hey, I grew it. It took me 30 years to grow it. And the worst of the reasons that are often very real is it was just for sale, right? And then, I had to. And I think it's similar to what we're seeing with real estate right now as well. Right? People are just buying it because they can, and they feel like, especially young millennials, so they feel like they'll never own a house if they don't, bet everything to acquire one. Anyway, maybe this is super interesting for me, but I'll pause here, Melanie.
It's so good to see all of the different sides. And one of the questions that I had for it is, do you think that these reasons are the same, whether it be a really small company, a large company? What are the major differences in reasons, do you think?
Well, that's a phenomenal question. I think for an acquisition, I think, if you're craft foods, all of this is fair. All of this plays into it. Sorry for my mouse. But if you're a small company, I think you typically have more appetite to grow and pursue different avenues to increase your size. I think when you see this psychology, it plays more into executives that are pressured by the board, for example, or by the competitors. They have to return capital. They have to signal something to Wall Street. They have to, go out and say, we're going to improve our share price, for example. I don't know if that makes sense.
Yep, definitely. Yeah, there's a big difference there. One is growth, and the other is kind of like almost like they feel like it's a necessity, right?
Yes, exactly.
A necessity for survival. I love it.
Yeah. So, look, for perhaps people that are intrigued, I mean, this is sort of your typical process, for a company that is being methodical about growing through acquisitions. And big companies or small and medium-sized companies will hire some sort of consultant banker to help them define what exactly is worth looking into, right? So, if you're Coca-Cola, you're going to say, hey, we'll love to grow and the Philippines, or we would love to grow in the non-carbonated drinks or water, or adjacencies, or Pepsi when they decided to acquire Frito-Lay, for example. So there's a lot of reflection that goes into where to deposit your investments and where to grow. And this is sort of how it looks when you kind of hire a banker, right? This is some work that we did for a large European agrochemicals company back in the day, and they said, hey, we have $300 million. We need to grow in the United States, and we need to grow in this type of crop enhancement solutions. So we just kind of drafted a very thorough, not this one, right? This is just sort of the pretty charts, but we drafted a very thorough criteria and helped them acquire what we did. And the reason why you hire a banker is, if you're, the DuPont company or Dow Chemical or whatever, a large company, you start calling your competitors or the target, and they say, hey, General Electric just called me. The target is going to immediately associate that with a large checkbook. So you want to have the banker, you want to have someone that calls in confidentially and triggers your interest in selling, for example. So obviously, once you do that, you're going to start calling a lot of companies, and people will say, sure, I love to have a conversation, and that just kind of takes its own life, right? I mean, you start trading potential offers, for example. You say, hey, I love to buy your business for XYZ type of dollars, and you start a mini negotiation process, and then you start a full diligence type of endeavor. So far, so good, Melanie?
I love it. I was just thinking, the question that comes to mind is, say, I know of a few businesses who are reaching this point where, their kids do other things, and they have the numbers that you're talking about, but they still feel like they're a really small business. What is the first step that you think someone should take when they're looking to go in this direction?
You mean to sell or to acquire someone else?
To sell.
And just for me to make sure I understood, so second generation takes over.
No, I'm thinking first generation, who the second generation, it's evident that they're not going to take over, but they need to figure out what's the next step for their business. They don't really have they don't know you yet. So what's the first step that they would take in even looking to start this process?
I think it's a mixed bag of, I call it 50% is just analysis. You have to be honest with yourself and, make sure you understand your own numbers. Numbers don't lie. So that's always beautiful to just take a cold analysis of how much you're selling, how much you're making, how much money you're actually taking to the bank, and, who do you owe money to? And then try to get an assessment on how much do you think the company is worth. That's always a phenomenal starting point. If the company is worth 10 million or 100 million, that can mean a lot to a lot of different people, right? I mean, if you're the sole owner of a 100 million business endeavor, that's phenomenal, right? I mean, you say, now it's a good time for me to sell and just sell in my yacht, beautiful. If you think it's worth working on this for a few more years and you want to grow from 5 to 10 in terms of valuation, it's a very personal decision that it really starts with analysis, with deep mathematical financial analysis to ensure that you kind of know the starting point. If you can get to a valuation price, phenomenal. But it also starts with a lot of reflection as well, right? And not to get into the touchy feeling stuff. I mean, it really pays off to remove all the noise, the financial noise and the noise from bankers and whatnot, and just really reflect on what exactly is it that you want. I mean, do you want would you enjoy retirement, right? I mean, would you enjoy not doing anything after working for 40 years? What will happen to the business if you're suddenly not involved? I mean, these are, deep type of questions that no financial analysis can really solve for it. You have to reflect, essentially. And I always recommend, writing it down and thinking about it over a series of days. I hope that answered the question.
No, that's the perfect answer. The perfect answer. This isn't something that people just want to jump on. There's a lot involved. It's really interesting to see, from the small company all the way through the process of the preparation and even the documentation and closing. How long does something like this normally take, would you say?
Oh my goodness. It depends on the size and the motivations of the seller, particularly. If you have a highly motivated seller and a highly motivated buyer, you can take as little as a month, in a professional run process. But that really only means that you have one bidder, for example, right? To really manage and extract as much value as possible, you have to dance with a lot of people, and get as many offers as you can, right? You have to have options in order to extract a better valuation. So a well-run professional process should take about 6 months. If the company is in well shape and the stars align. More often than not, it takes 9 to 10 months. And regrettably, there's been cases that just take 4 years for many reasons, right? I mean, I had one client that it was a large chemical distribution business. They were crushing it. It was a family-owned business, founder owned. And the guy not started, but 5 years ago he was selling $30 million. He got approached by this large, fancy public company that said, "Hey, we'd love to acquire you. You're a tiny competitor. You own the Hispanic market in the U.S. and I love that market. I want to buy you at $30 million. One-time sales, for example." Well, guess what? Next year they were crushing it, and they ended up at 50. So the seller said, "Well, that's cute. I love to sell to you, but not at 30 anymore. I love to sell to 50." And well, the buyer said, "Well, you're nuts, right? I mean, that's not going to happen." Conversations kind of ended. Then, on year number 3, the guy was crushing it at 60, for example, and trending for $60 million in sales. Big fancy public company came back and said, all right, learn my lessons. We'll love to buy you out at 60. Then, one of the executives of the public company retired or got poached to a different gig. So you got a new executive, came from all these big fancy schools, and they say like, well, I have a different take on valuation. So that restarted the whole negotiation process. And the last offer they received was for around $80 million, and with a new executive. But the seller was trending at 100. So that deal, fall through.
Wow.
Very long story again, Melanie, but
I love it. I love these real world examples, and especially people who, they don't do this for a living. I mean, this might be boring to you because you do it every day, but it's really interesting how so much can go into it, and it can fall apart. It's fascinating.
It really can.
But I love to see the company doing better and it going up and up,
Yeah, of course. They were crushing it. I mean, I have some content here on why companies sell or why families sell. We already kind of touched on some of this. I think, for families, the first 2 bullets are more related to families. And needless to say, if you get a unique valuation, you're gonna get a chance to crystallize and monetize the valuation. That's just a clear example. Or you're finally really looking to pass the torch. I had a client that phenomenal individual, 80 years old, had Alzheimer. The guy couldn't help himself and stopped working. He was just hustling every day. He was driving to his little manufacturing plant. He was doing chemicals, and it was that type of situation where he had 3 kids. None of them wanted nothing to do with the business. They all had money, and the gentleman couldn't. He loved that business. He had been working on it for 50 years. He grew it from nothing, and he didn't want to give it away. Not to anyone, not to the employees. The employees were just kind of working the plant, so they wouldn't have that kind of managerial capacity that the owner had, and he badly wanted to rest. He badly wanted to just go on vacation, but he also couldn't allow himself to let this business, go to the ground. So that was just a great opportunity for a fund like us, right? I mean, just we're 2 young guys that are literally looking to take that torch and continue growing that business. So that's a clear example of something that we're looking for. Anywho, so let's see. I got some other. Sorry, Melanie, you had a question or?
No, you're good. You're good. I'm just switching us back to the other view.
No, I was just gonna say. I mean, I have more technical stuff on kind of what happens with this psychology, right? I mean, because for that client that took 4 years to sort of try to transact, theoretically companies have a valuation, much like houses, right? I think houses are a better analogy here. You own your house, and then you have an order of magnitude of what you think the house is worth. And say, the house is worth $100,000, and you can make this analogy with companies. It literally is the same. Ways to increase that 100 baseline valuation. A lot of it is just psychology driven, right? So if you suddenly start getting a lot of attention from other bidders, from your neighbors, that for no reason is just going to drive the price up. Well, for the only reason that people want it, right? Supply and demand. But intrinsically, you have your own valuation. Now, if you have a buyer that has synergies for companies specifically, that has benefits by acquiring or absorbing your operation, that theoretically should render in an improved valuation. But I think the better attribute in this chart is just the competitive dynamics or the scarcity component. If you are a seller and you get 10 offers, you can really do wonders with 10 offers, right? I mean, you people have to compete. Your valuation perception really gets distorted as you see from other seats, for example. So, for example, this chemical distributor in working in the Hispanic market got this offer from this other public company that theoretically had all these synergies, had management, had better production lines, had better cost, had everything. But the valuation they were seeing was just so reduced that when a financial buyer came and saw this, they actually bid higher than the company that kind of knows their stuff and has experience in the market. So, to put a absurd example, right? I mean, the strategic buyer, let's call it, offered 50 at a time that they were selling 60. And here came the financial buyer with no synergies and offered 65, for example, and they thought that was a fair valuation. What immediately happens once you go back to a strategic buyer that tells you very matter of factly that the value is 50, you say, well, guess what? I understand kind of where you're coming from, but someone else doesn't have the synergies and experience that you have is bidding 65. The CEO of the public company will say, shoot, what are we missing? They're going to steal this from us. What am I doing wrong? Could it be that we had a mistake? And the new offer is going to come at 60 just because they thought, that happened, or the asset was going to get stolen. Anywho, making a little pause here, Melanie. I don't know if there are any questions, comments.
Anything so I want to say a lot of people don't think about it, but no matter what platform you're watching us on, if you put something into the comments box, I will see the comments, and we will be definitely going over a bunch of them at the end. I'll just take a look through. Here we go. Here's one. How do you usually derive the value of companies that are being bought out?
That's a beautiful question, and I don't mean to dance around the question. I think it really depends. It depends on the situation. So, value is one thing for a seller, and what you think is worth 100, a buyer may think is worth 50. So it's impossible to really know. I think as a banker, you always strive to provide a very independent view on valuation. And there are many ways to do it. Let's see. I think I hope I have some content here because, here, perfect. So look, at some point in life we had, I don't know if people can see this chart, but at some point in life we had a client that they were in the IT distribution industry. And it's a company that had 100 million in sales, 8 million in cash flow or EBITDA for those in finance. Very nice, profitable operation. And, guess what? The seller said, well, shoot, I'm worth 300. And literally, right? And then any rational buyer will say, I don't know, man. I mean, you out of 100 million you sell, you only really make 8 million in cash flow. So that's not very impressive. That's 8% of your operation. So I really think you're worth 5 times that. So $40 million. Again, exaggerating a bit, but not that far off from kind of what happened here. So, you hire, in this case, this seller hired us, and we ended up going through this whole thorough valuation process. And you do this different ways, right? I mean, the typical, most academic way of doing this is you have to forecast or project the expected cash flow of the business and discount it all the way to present value for those that are acquainted with this. And you'll get some sort of valuation based on the expectation of what the company is going to grow for the next 5, 10 years or perpetuity, right? That's the sort of academic way of seeing this. The practical way is just knowing kind of what happened for similar companies, right? So for someone that has been in the IT industry for a while, people might say, I know for a fact that the exact same company was acquired for 10 times profits 2 years ago. So that's just a metric, 10 times profit or 2 times sales. And then you sort of start getting this sort of metrics based on historical events that kind of give you a picture. It's the exact same thing as the comps when you're buying a house, literally, right? When you get appraised, for example. So, a good way to smooth out those is to literally map out every single valuation, right? I mean, you're going to create a little forecast and you're going to map out what will happen if you own this business and grow it conservatively or very optimistically. And, I don't know if people can see this, but we have like 3 little green charts or bar charts that will say, this is the value under the optimistic scenario. This is the value under the conservative scenario. And the red charts are the historical market events that I mentioned, right? Or the comparables. Making a pause there to see if anything comes out of this.
Yeah, to take a look, we actually do have a bunch of questions. People are really excited. And like I said, this is stuff that, may seem boring to you, but this isn't, people don't usually get to talk about this every day. Another question was, what usually rationalizes increases in the value of a company during negotiations?
So, great question, John. It depends on the stage, but let's on the stage of the negotiation. Let's assume that you're at a stage that you can modify that valuation. There are internal factors, and that is growing, right? I mean, it's just literally the previous example. If you negotiated a purchase price when you had $50 million in sales and the valuation was 50, if this year you expect to double revenues, you deserve more value for that, right? I mean, that you will leave a lot of money on the table should just decide to go with the prior type of metric. So those are sort of internal triggers, I guess, that you can, or levers, excuse me, that you can extract more valuation. Obviously, external triggers are getting other offers. And I think, honestly, that's the better one. If you get more offers, you have more leverage and you have points of reference, right? I mean, you can tell to the one party you're negotiating with, you can say, hey, guess what? Your competitor, or assuming you can disclose that, someone made this offer and that's 25% higher. What are you going to do? And if they don't decide to up their offer, just go with the next one, right? I mean, but having optionality is crucial for any sort of negotiations.
Yeah, that's great. Sorry, I was just bringing up the question in case anyone didn't remember it. No, that's great. There are a bunch of questions. What about we'll kind of filter through these and we'll circle back a little bit in case people need to log off just to make sure they get some answers. Is that okay with you, or do you want to go to the next one?
No. I think I'm happy to answer questions because the rest is just technical fluff. So happy to delve into any of the technicality or anything else.
Yeah, I mean, I would love to just jump around a little bit. Ron Alvarado, he is a longtime member of the chamber and he owns a very successful business. He asked, what are the key ingredients for a successful merger?
Well, hey, Ron, thank you for the question. Tough question. I think for the seller, having a clean set of financial books is crucial. You need to buyers and everyone kind of needs to play with symmetric information, and accounting is kind of where you start. It really goes a long way if you have no contingencies or minds in the business, meaning you have an employee that sue you or a customer, that type of stuff. That's usually easier to move along. If you have a transition plan, it's a lot easier, and that is there's management in place that can replace the owner. If the owner is a large or is just a key man of the operation, it's hard, right? It's hard for the employees, hard for the customer, suppliers, and replacing that with just an executive, it's sometimes extremely hard to do. So having systems and management in place is a huge asset to trying to do a potential transaction. I think for on the other side, if you're trying to acquire something, just having an open mind and being and look, I don't mean to get into the touchy feely stuff of this, but and I mean it because this is too corny, but having empathy, right, and really thinking this, really thinking about this deal and in from both sides or both perspectives. Sometimes I see buyers just getting too focused on what matters to them, and while that's good, if you really want to do a deal, you will never do a deal if you don't really think as for what actually matters for the seller. Buyers just often want to minimize the risk, and there's absolutely no risk. There's no riskless transaction. Every single transaction has a risk, and no different than when you're buying a house. You don't know if the pipe's going to burst or whatever. You have no idea because you don't know the house. Maybe you don't know the neighborhood. And buyers, especially big companies, they're just trying to minimize every single risk. And well, guess what? And the seller wants to maximize valuation and maximize their time allocated to this little adventure, right? I mean, we talked about a deal taking 6 months, 9 months. That's a lot of time when you're running a business. And to have someone coming from this big fancy school or this big fancy public company ask you about what you did 5 years ago and what are the ways to mitigate this risk, it's just a complete obstruction of what actually matters. Sure, the seller wants to sell, but the seller took a lot of risk to get to where they are, and he's expecting that a buyer will have the similar risk return profile. I don't know if that makes sense, but you really got to think on both ends to make a deal happen.
I love bringing that up because, people think that things at this level are just about money. All they think of is dollar signs and numbers. But at the end of the day, there's so much more involved. And there is not one good, successful business transaction that doesn't happen without empathy. You have to have empathy in every situation. It makes business better. It makes profits better. It makes happy customers. It just all around.
Absolutely. And I mean, just, sure, people want to monetize, but they also want to make sure they're living their business, their baby in the right hands with the right people. If you're a jerk, who wants to do business with you? Just because you have a large checkbook? I don't know. I mean, often sellers already have money. So it really goes a long way to be kind and show empathy.
I want to talk a little bit about, there's another slide that we haven't got to yet. It's the divestiture process summary, divestiture. I'm not sure which way you say, but I want to talk about that process and those steps that you had mapped out. I think that's really important for our audience to kind of understand and just, get a little hold of.
Yeah, I mean, I think I feel like I'm going to bore your members, but I think, typically when an owner or a company for that matter came and said, hey, I love to sell, you can just say, sure, put me on a little list and add me on where you sell companies, but that doesn't really happen for companies that are well run and well sold. I think this concept of analysis and reflection plays a lot into it. So you really have to understand what's the key value proposition of the business so that you can showcase that, because often the business or the owner or the management team knows it, but it really goes a long way to analyze it, map it, describe it in a well presented document so that you can show and position it to potential buyers, right? Immediately after that, you really gotta map and identify every single potential buyer into this, because remember, in a well-run process, we're trying to maximize the number of potential offers you're going to receive. So if you have to contact 200 buyers, so be it. You have to, the bigger the funnel, the better. That's going to maximize your odds of increasing valuation. Then you start distributing this beautiful material that the banker or the consultant or someone prepared, and start positioning the value on the bidders, right? I mean, you're going to say this is a beautifully well-run business. The key investment highlights of it are X, Y, C. These are the potential synergies, on and on. And then, people will just say, well, hey, we just did a large acquisition in Japan. We are a little bit more focused on Australia, so we're passing. And suddenly out of 200, you'll have 80. And those 80 will sign a little confidentiality agreement. We'll review the materials, and we'll just, maybe out of 80, 20 or 15 will submit an offer, right? And 15 is a lot, but, we'll submit an initial type of offer. And you get all sorts of crazy stuff, right? I mean, you get, sure, we want to buy this business for 5, and then another one will say, we want to buy this business for 100, and then others will say, we want to buy this business for 50, but you need to provide financing for the next 5 years, meaning I'm going to pay you 10 every year for the next 5, type of thing. So you get all sorts of structure. So your advisor, your banker will help you kind of map things out and put an appropriate value for this. And then, you'll pick 1 or 2 offers, call it, and then you'll move on and allow these buyers to make their audit, make their diligence, make good questions, visit, yada yada, and ultimately you're going to have a best and final offer, and hopefully exchange cash for shares or assets. Again, this may take 6 to 9 months and a lot of work.
Yeah, that's a lot. I like one of the questions that we have. I think it's really relevant here after we talked about that process. What does the team look like to make this successful in going through these, especially these large acquisitions?
I mean, it really varies on the style and the culture of the large acquirer. You often see very nimble companies. You have, and it depends on the size of the transaction, but for very large transactions with very large companies, you have very large teams. I've been as big as 40 or I guess 50 team members, and you have 30 executives from the company that's looking to acquire, and you have 10 lawyers and 3 tax advisors, 2 HR advisors, 3 bankers, and 2 wealth managers. It just gets big and big and big, and the IT consultant and whatnot. Internally, if you're a multinational, you need to anticipate for every single function, right? You need your IT people, you need your HR, environmental, commercial people. It really gets pretty big. Again, depending on the size. If it's a tiny deal, sometimes you just have the one M&A executive or corporate development or CFO just going to the owner and say, hey, here's a check. We'd love to acquire you. I hope, Christine, that's a good answer, but it really depends.
Yeah, no, that was a great answer. I'm sure it varies widely, but it's interesting to even hear the different types of teams that are needed. You know what I mean?
Yeah. You need to anticipate everything.
We have a question from Richard. I know Richard owns multiple companies, including Affinitive, which is a finance company. He just started a hedge fund. Definite business guy. He's been in for a while. He said, have record low interest rates caused you to increase debt in the capital structure?
Yeah, absolutely, right. I mean, that's the beauty of this environment right now. It would almost be irresponsible to not take advantage of it. I think, and it goes both ways. I mean, I think because money is so cheap right now, people are flush. Financial buyers are flush with capital and equity, particularly, and no surprise, company prices have gone in multiples for you, right? I mean, have gone dramatically up. So short answer is absolutely, but you also see the after effect of all this irrational exuberance.
Great answer. Well, there's another slide that I really love. I think it was your wrap-up slide, which is the decision-making map, buy, sell, and holding a company. I think that this is so important. It kind of touches on a lot of the things that we got to. Tell us a little bit about this map and your thought process behind it.
Well, look, Melanie, I'm laughing a bit because this thing is so complicated. Like, I wish I had a good punchline to kind of wrap things up, but we used to just, have something like this to help business owners or families or companies just kind of decide on what exactly they want to do. And like I mentioned before, it really started with valuation. So, for kind of moving you guys everywhere, but back in the day, we used to kind of project all these scenarios and run sensitivity analysis, and we'll say, hey, conservatively, we can grow this business, all the way to this level, optimistically grow even more. And once you know your potential and how much you need to invest and what are the risks involved, you kind of get a little idea of what you can actually do, right? So, for us, my prior gig, it kind of started here. You have all these scenarios. Do you like the scenarios? Do you like the risk and return profile? If yes, then, hold it and try to grow organically, right? And look, very debatable, but that was just a quick, simple way to map things out, because people were super confused by the amount of options they got. Did you not like the alternatives or the risk return profile?
Yes,
No.
I wanted to touch on that, but I just thought that this was so interesting, and I thought that it kind of pertained to some of the things we were talking about.
Yeah, no, but just finishing up here. So when we ask these people, like, did you not like the profile? No. Why? Valuation. If the valuation is attractive, then explore a sale. If it isn't, then try to grow via a joint venture or partnership type of thing. Anyway, just gets complicated, but obviously for anyone that kind of is facing these problems, these are phenomenal problems to have. And happy to talk and lend a hand to any of your members that are kind of facing these issues or would like to connect aside from all of this.
Absolutely. Well, I would love to there's a few more, there's a bunch of questions, but we can address a few more. We did start a little late. If you don't mind going over, we can answer a few more. All right, great. Let me see.
Just an easy one, though.
Oh, gotta go to the next.
Here.
No, just kidding. What are
literally the opposite
of forecasts that materially did not pan out, or objectives that are not met post-merger / acquisition?
So obviously, great question, John. So for a buyer, that sucks. That's awful. The executive that kind of signed a check is going to get crushed in his next board meeting. There are ways to mitigate that, as you may anticipate. You can structure a deal that is contingent on the company being acquired to achieve those objectives. That is, you hold a little bit of the purchase price until the company proves that it's trending towards that goal. And the repercussion for the seller, it's relevant if and only if it was pre-agreed to have repercussions, right? If you sold and the new owner didn't materialize your forecast, good for you, bad for them. But if your valuation was contingent on that, is the opposite. So
Is that your
yeah.
nice way of saying it's too bad?
Uh, yeah, I mean, I guess. Yeah, I think so, right? I mean, it's too bad for the buyer that just want to achieve those goals. And look, that's precisely one of the reasons why buyers spend so much time diligencing these businesses because uh, you now have new executives running a business that was run by an owner for 40 years, and it has a different rhythm. It has different type of trust with all the community and stakeholders, right? So it is tough to just replace that type of people.
Mhm. John is on fire over here today. He said, "What are the tax implications of merging companies?"
John, I'm gonna punt that one. I mean, I have an idea, but I'm by no means a tax expert, and you can judge by anyway. No, I think obviously there are all sorts of tax structures that make a merger extremely efficient. There are many complicated, creative trusts, and all this things you can do to make a merger practically tax zero and extremely efficient. Companies that merge, they usually don't pay taxes because it's just a kind of share type of deal. Whereas if you kind of exchange assets, you probably you'll be taxed in one way or another. But any tax advisor worth its salt will be able to navigate this question better than I ever would.
No, that's great. Stick with what you're good at. We're going to take one more question and then we're going to do a little bit of a wrap up. I think we did this one. Oh, here's the one that I wanted to touch on from John again. He said, "Are there instances where the government intervenes on mergers that have already been agreed upon?" This is something that,
Oh my goodness.
a news story that we hear about, but we don't get to hear, like your thoughts, the background on it. Do you have experience with that? Tell us. I'm very
Yeah,
interested.
John is crushing me with questions, but I think that's a great question, and the answer is yes. I think there's materiality to it. Excuse me. That is, there's a threshold of deal size that it really doesn't matter. Really doesn't matter for government, but more often than not, depending on the sector, you'll see deals that are contingent on approvals. That not only includes board approvals, but also government approvals. I think there's been many famous cases, particularly in technology, right? There that being acquired by a Chinese player is highly sensitive in the U.S., or the telecommunications sector is highly strategic in the U.S., so that usually has a lot of repercussions and protections that have to kind of go through the FTC, for example. And in other developing markets, any transaction size around 60 to 80 million dollars has to be approved by the, how do you call it, the anti-monopoly type of division, right? And same happens in the US. A lot of the transactions have to be approved by it'll come back to me, but the same regulatory institution. So short answer is yes.
Wow, yeah, that is crazy, and I have heard those stories, so I'm sure that that's hard to deal with on your end.
It's a pain. It's a pain in the back because the whole thing is first of all, there's a lot of money that has been spent, and then your destiny. You're not controlling your destiny. You're just hoping that the government will kind of allow you to complete the transaction. There's usually a lot of money involved, but I like to think, I guess, that's just for the better, right? I mean, I don't know. That's also very debatable, but anyway, I'll pause there.
Yeah, well, I want to see. So we did miss one or two of your slides. Do you want to go over that? And also, I would love for you to just even as part of the wrap up to talk about, exactly what you're looking for in a company and where people can find you. So I did put your link in the chat box. Everyone should see it, as well as a link to connect on your LinkedIn.
Yeah, trying to see if I had something, more material on kind of what we're doing. But look, very briefly, I mean, as I mentioned before, if you come across companies that are facing succession issues, companies that need management, and, obviously, cherry on top will be that they have a Latin American component. Please keep us in mind, keep us in your radar, and not only an owner that is Hispanic, but just a company that has a large Hispanic employee base or a large Hispanic customer base or supplier base. We're better suited to work with these companies, and just keep us in your radar. We're this new fund run by Hispanic immigrants, proud Hispanic Americans, and we'll love to help. And oh, by the way, we also pay handsome referral fees should any of this materializes. But Melanie, I'm so grateful for the opportunity. You guys have been a very tough audience with all the tough questions, but I hope I was up to the task, and I certainly enjoyed talking with all of you.
Well, just so you know, before we get off, there are some really glowing compliments in the comments. I'm already receiving text messages about the information. I know, like you said, this is what you do every day, so it can seem boring, but for us, this is new, it's exciting, we're learning. We're very, very happy to have you, very appreciative of also what you do, for the community and all of that. So thank you for being here.
No, thank you. And by the way, make sure let's connect on LinkedIn, or make sure you check our website. I'll try to put the little URL here. That's our website, and our LinkedIn is somewhere in there. Happy to connect, aside from all this. And thank you so much, Melanie, and thank you everybody that joined us.
Yes, I'm just copying that over so that everyone can get the link one more time. And I will see you soon. And everyone else, thank you. Thank you so much for joining us again here this week. The Latino Pittsburgh Digital Speaker Series is an initiative of the Pittsburgh Metropolitan Area Hispanic Chamber of Commerce. Its goals are to share relevant information, inspire growth, and foster opportunity. Speakers and workshops include community leaders and members, as well as other individuals and programs that have a positive impact on not only the Hispanic community, but the region at large. Next time, we're going to be talking to the SBA about some of the different certification programs that they have and how they can help your business. So I hope to see you all in the coming weeks. I hope you have a wonderful holiday weekend, and we'll be seeing you soon. If you would like to become a speaker, please email chamber@pmahcc.org, and you can always learn more at our website, again, pmahcc.org. You can learn about membership, the scholarships that we give, donate, or see any of our other speakers. Hope to see you next time. Have a great day.